Something strange happened this week, and almost nobody framed it correctly. Gold pushed back above $4,100 an ounce. At the very same time, long-term Treasury yields spiked to levels not seen since 2007. Normally, that combination doesn't happen. Gold and yields are supposed to move in opposite directions. When yields rise, holding gold becomes more expensive because gold pays no interest, and investors have somewhere better to put their money. When yields fall, gold becomes more attractive again. That's the textbook relationship, the one taught in every introductory finance course. And yet here we are, watching both climb together. So either the textbook is wrong or something underneath this market is telling a story that the headlines aren't quite capturing. I think it's the second one. And by the end of this, you'll understand exactly why gold and yields rising together isn't a contradiction at all. It's actually one of the clearest signals the market has sent in years if you know how to read it. Let's start with what actually happened because the sequence matters more than most people realize. On July 29th, the Federal Reserve held its benchmark interest rate steady, keeping it in a range of 3.5 to 3.75%. On the surface, that sounds uneventful. Central banks hold rates all the time, but underneath that decision was something far more revealing. 3 policymakers on the committee dissented, arguing the Fed should have raised rates instead of holding them. That's not a small detail. 3 dissents on a single rate decision is unusual. It signals real disagreement inside the institution that's supposed to project unity and certainty to the market. Fed Chair Kevin Warsh, addressing the press afterward, said something that stuck with a lot of bond traders. He said he thinks it's a good thing if the bond market moves based on economic data rather than on what the Fed itself signals. That's an interesting thing for a Fed chair to say, because it's almost an admission that the market has stopped waiting for the Fed's guidance and started pricing risk on its own terms. And that's exactly what happened next. In the hours and days following that meeting, something unusual unfolded in the bond market. The short end of the yield curve, the 2-year Treasury, actually fell slightly, but the long end did the opposite. The 10-year Treasury yield climbed toward 4 2/3%, and the 30-year Treasury yield surged past 5.2%, its highest level since 2007. Think about that for a second. Not since before the financial crisis has the government had to pay that much to borrow money for 30 years. When short-term yields fall while long-term yields rise, traders call that a bear steepening of the yield curve. It's a specific pattern, and it tells you something specific. It tells you the market isn't worried about what happens next month. It's worried about what happens over the next decade. Here's why that distinction matters so much. If inflation fears were driving this, you'd expect yields to rise broadly across every maturity because inflation erodes the value of any bond regardless of when it matures. But that's not what's happening. Short-term yields are actually easing. It's specifically the long end of the curve that's under pressure. And when economists dug into what was actually driving that 30-year yield higher, something interesting emerged. It wasn't primarily inflation expectations. Those had barely moved. Instead, a meaningful part of the increase came from something called the term premium. Now, term premium is one of those phrases that sounds intimidating, but is actually a fairly intuitive concept once you strip away the jargon. When you lend money to someone for 30 years instead of 2 years, you're taking on more risk, not just inflation risk, but the risk that something unexpected happens over that long stretch of time, a fiscal crisis, a change in who's willing to keep buying that debt, a shift in how much trust investors place in the institution issuing the bonds. The term premium is the extra compensation investors demand for taking on that uncertainty. And when the term premium rises even while inflation expectations stay flat, it usually means something structural is bothering long-term lenders. Not what happens next quarter. What happens to the credibility of the whole system over the next decade? That's the piece Wall Street commentary started calling almost overnight an inflation credibility shock. Not a shock about current inflation. Remember, the Fed just held rates and inflation data has actually been cooling. It's a credibility shock about whether the institution managing monetary policy is still fully trusted to keep future inflation under control. That's a very different problem than a bad inflation print. A bad inflation print gets fixed by raising rates for a few months. A credibility problem doesn't get fixed that easily because credibility isn't something a central bank can simply announce back into existence. It has to be earned back over time through consistent action, and markets don't always wait patiently while that happens. To understand why 3 dissenting votes can move a market this much, it helps to understand who actually buys 30-year Treasury bonds in the first place, because it's not the same crowd that trades gold or stocks day to day. The long end of the Treasury market is dominated by pension funds, life insurers, and foreign central banks, institutions that need to match long-dated liabilities decades into the future, or that hold Treasuries as a core reserve asset precisely because they're supposed to be the most predictable, least dramatic instrument in the world. These aren't investors chasing headlines. They're the most conservative capital on the planet by design. So when that specific corner of the market starts demanding a bigger premium to hold 30-year paper, it isn't retail speculation talking. It's the most risk-averse money in the system quietly repricing how confident it is in the next 10 to 30 years of policy discipline. That's a very different signal than a single bad jobs report or a one-off inflation surprise. And it's part of why experienced bond traders don't shrug this move off as noise. There's also a mechanical piece worth understanding because it explains why this kind of move can feed on itself. The U.S. government has to keep issuing new debt to fund existing obligations and roll over maturing bonds, regardless of what the yield happens to be at the time. When long-term buyers pull back even slightly, or simply ask for more yield to show up, the Treasury has to offer higher rates to get the same auctions filled. Higher borrowing costs then increase the government's own interest expense, which adds to the deficit, which increases how much debt needs to be issued going forward. It's not an immediate spiral, and there are plenty of stabilizing forces in a market this large and liquid. But it's the kind of feedback loop long-term lenders think about instinctively, even if it never appears explicitly in a Fed press conference. That's part of what a rising term premium is quietly pricing in. So let's actually look at the inflation numbers, because this is where the picture gets more nuanced and where a lot of casual market commentary gets it wrong. The most recent Consumer Price Index report covering June showed headline inflation easing to 3.5% year over year, down from 4.2% the month before. Core inflation, which strips out food and energy, cooled to 2.6%, down from 2.9%. On a monthly basis, prices actually fell, the largest one-month decline since the pandemic disruptions of 2020. A meaningful part of that improvement came from energy prices retreating, tied to a pause in the conflict between the United States and Iran. So on paper, inflation is moving in the right direction. That's the part most headlines focused on. But here's the question that inflation report doesn't answer, and it's the question the bond market is actually asking. If inflation is cooling, why are long-term yields still elevated? And why did they climb even further right after the Fed's decision? If this were simply about current price pressures, falling inflation should have pulled long-term yields down, not pushed them up. That contradiction is the heart of what's happening right now, and it's worth sitting with for a moment rather than rushing past it. There's a useful historical parallel here, and it's one that many veteran market watchers reach for instinctively this week. 2013 so-called taper tantrum. Back then, the Fed hadn't even raised rates. It had simply signaled that it might eventually slow down its bond buying program. That signal alone was enough to send long-term yields sharply higher and gold into one of its worst monthly declines in decades. The lesson from that period wasn't about what the Fed actually did. It was about how sensitive long-term bond markets are to any perceived shift in a central bank's commitment to its own framework. The market doesn't just price in today's policy. It prices in what it believes policy will look like years from now, and it adjusts violently the moment that belief wavers. What's happening today has a different flavor, but a similar mechanism. It's not that the Fed signaled tightening. It's that 3 officials publicly disagreed with holding steady. At the same time, inflation data is genuinely improving. At the same time, energy markets remain hostage to an unresolved conflict in the Middle East. And at the same time, the government's long-term borrowing needs continue to grow. Put those pieces together, and long-term lenders start asking a very reasonable question: is this institution going to stay disciplined enough for long enough to actually anchor inflation expectations a decade from now? When that question starts circulating widely enough, it shows up exactly where we're seeing it, in the term premium, in the long end of the curve, in that 30-year yield breaking a 19-year high. It's worth mentioning 2 other historical episodes here briefly, because each adds a slightly different angle. Go back to 1994, a period bond traders still refer to as the bond market massacre. The Fed raised rates more aggressively than markets expected that year, and long-term yields spiked violently, catching even sophisticated institutional investors off guard and causing significant losses across fixed income portfolios. The lesson from 1994 wasn't about inflation either. It was about how quickly long-duration bonds can reprice when the market's assumptions about future policy shift even modestly. Then look at the early 1970s, a genuinely different era when the U.S. abandoned the gold-backed dollar system entirely. That period saw persistent doubts about currency stability translate into one of the most sustained gold bull markets in modern history, as investors sought an asset whose value didn't depend on any single government's promises. Neither of those episodes map perfectly onto today. No historical parallel ever does, but both illustrate the same underlying principle. Long-duration assets, whether bonds or currencies, are exceptionally sensitive to shifts in institutional trust, and gold has repeatedly served as the pressure valve when that trust wavers. Now, let's bring gold back into this conversation, because everything we just walked through explains why gold's reaction makes far more sense than it first appears. The standard assumption is that higher yields are bad for gold. And in a narrow mechanical sense, that's true. Higher yields raise the opportunity cost of holding an asset that generates no income. But that relationship assumes investors trust that the higher yields reflect a healthy, well-anchored system. When higher yields instead reflect doubts about long-term credibility, about the sustainability of government debt, or about whether a currency will hold its purchasing power over the coming decade, gold stops competing with bonds and starts being priced as an alternative to the entire system those bonds represent. That's a completely different dynamic, and it's one gold has responded to before in different eras, under different circumstances, but with a consistent logic. This is really the difference between nominal yields and real yields, and it's worth explaining clearly because it resolves the apparent contradiction entirely. Nominal yields are the number you see quoted, the 4.6% on the 10-year, the 5.2% on the 30-year. Real yields are what's left after you subtract expected inflation. Gold has historically tracked real yields far more closely than nominal ones. If nominal yields rise because the market is losing a bit of faith in long-run price stability, meaning inflation expectations over the long run are quietly drifting upward even if this month's CPI print looks tame, then real yields can stay flat or even fall even as the nominal number climbs. And when real yields stay low or negative, gold tends to do exactly what it's doing right now. There's another layer worth adding here because it's been building for years and doesn't get enough attention in day-to-day market coverage of central bank buying. Central banks around the world, Poland, India, China among the most consistent, have been accumulating gold at a pace not seen in decades. This isn't a short-term trading decision. It reflects a longer-term strategic shift, often described as de-dollarization, where countries diversify their reserves away from being overwhelmingly concentrated in U.S. Treasury securities. When the institutions that traditionally absorb long-term government debt are simultaneously diversifying into gold, you get exactly the pattern we're watching: upward pressure on bond yields because there's relatively less structural demand soaking up that long-term debt, and upward pressure on gold because that same capital is flowing somewhere else. These aren't two separate stories. They're two sides of the same capital flow. Before we move on, it's worth grounding all of this in something more tangible than bond math, because these yields don't stay confined to Wall Street trading desks. They flow directly into the real economy. 30-year mortgage rates track long-term Treasury yields far more closely than they track the Fed's short-term policy rate, and they've already climbed above 6.8%, near a one-year high, as this move has unfolded. That matters enormously for anyone shopping for a home right now or anyone with an adjustable rate mortgage coming up for renewal. Corporate borrowing costs move in a similar direction. Businesses financing long-term projects, from factories to data centers, face a higher hurdle rate to justify that investment when long-term yields sit near two-decade highs. So this isn't an abstract story about bond math for its own sake. It's a story about the cost of capital across the entire economy quietly resetting higher, even while the Fed's own policy rate hasn't moved at all. That disconnect, a Fed on hold while real world borrowing costs climb anyway, is itself part of why so many market participants are paying closer attention to the long end of the curve than to the Fed's headline decision. Let's step back and look at gold's actual path through this year, because the volatility has been extraordinary, and understanding where we've been helps make sense of where we are. Gold first crossed $4,000 for the first time ever back in October of last year, then pushed briefly above $4,300 following a Fed rate cut at its final 2025 meeting. What followed in the weeks after was a remarkably fast escalation. A U.S. strike inside Venezuela in early January, alongside a threatened 100% tariff on Canadian imports amid a separate trade dispute, and signs the Bank of Japan might need to step in and support a weakening yen, all combined to push gold to its all-time high above $5,500 in late January of this year, capping a bull run that had been building steadily since late 2023, driven by that same combination of central bank accumulation, a weakening dollar, and mounting geopolitical stress. From there, it corrected sharply, more than 25%, falling back toward the $4,000 level by mid-year as some of that acute stress eased and the market took a breath after an extraordinary run. That kind of correction, even within a longer uptrend, tends to shake out short-term speculators and test the conviction of longer-term holders. Gold spent weeks consolidating in that zone, unable to hold sustained moves above roughly $4,300. Then, late last week, as the United States paused airstrikes in the ongoing conflict with Iran, and the Fed's decision landed with all this underlying complexity, gold pushed back above $4,100 for the first sustained period in about a month. What that price action tells an experienced chart reader isn't gold is definitely going higher or gold is definitely going lower. It tells you gold is currently caught between two powerful opposing forces, and the market is working out which one wins in the near term. On one side, you have a genuine, if fragile, geopolitical de-escalation and cooling headline inflation, both of which reduce the urgency for safe, haven buying in the short run. On the other side, you have this deeper credibility question building in the bond market, continued central bank accumulation, and a level of policy disagreement inside the Fed itself that hasn't been this visible in years. Markets rarely resolve tension like that quietly. They tend to resolve it with volatility in both directions until one narrative clearly dominates. It's also worth separating out who's actually doing the buying underneath these price swings, because gold demand isn't one uniform thing. There are broadly four distinct sources of demand, and they don't always move together. There's central bank buying, which we've already discussed, driven by long-term reserve strategy rather than price sensitivity. There's exchange-traded fund flows, where investors buy shares backed by physical gold, and this pool of demand tends to be the most price-sensitive and momentum-driven of the four, expanding quickly during rallies and contracting during corrections. There's jewelry demand, concentrated heavily in India and China, which actually tends to fall when prices rise sharply, since higher prices make gold jewelry more expensive for everyday consumers in those markets. And there's investment demand in the form of coins and bars, which tends to rise during periods of acute uncertainty, functioning as a genuine store of value purchase rather than a trading position. When all four sources are buying at once, that's when you tend to see the sharpest, most durable rallies. When they diverge, say, central banks still accumulating while ETF holders take profits, you tend to see exactly the kind of choppy, directionless consolidation gold has spent much of this year in. Watching which of these four groups is actually driving a given move tells you far more about its durability than the headline price alone ever could. It's worth pausing here to talk about investor psychology, because this is where a lot of people get shaken out of positions at exactly the wrong moment. After a 25% correction from an all-time high, plenty of investors who bought gold near the top were sitting on real losses for months. That kind of drawdown tests conviction in a way that a smooth, steady rally never does. Some capitulate near the bottom of the range, selling out of frustration right before the next leg higher begins. Others chase the next spike upward out of fear of missing out, buying right as short-term momentum peaks. Neither behavior is irrational exactly. It's simply how humans respond to uncertainty and drawdown. But it's worth naming clearly, because recognizing that pattern in yourself is often more valuable than any specific price prediction anyone can offer you. There's one more historical thread worth pulling on, because it shows what it actually takes to fix a credibility problem once markets start pricing one in, rather than simply hoping it fades. In the late 1970s, persistent inflation and a series of policy missteps had badly damaged the Fed's credibility. Long-term yields and gold both surged as investors concluded the central bank either couldn't or wouldn't bring inflation under control. It took Paul Volcker, appointed Fed chair in 1979, deliberately pushing interest rates into the high teens and tolerating a genuinely painful recession to convince markets the Fed was serious. That's the historical benchmark for what restoring credibility actually costs. Not a press conference, not a single rate decision, but a sustained, uncomfortable commitment maintained over years. Nobody is suggesting today's situation rhymes with that scale of dysfunction. Inflation today, even at its recent peak, was nowhere near the double-digit levels of that era. But the mechanism is instructive credibility, once genuinely questioned by the market that has to finance the government's debt, tends to require more than reassuring words to rebuild. It requires a track record. And building a track record takes time the market spends. In the interim, pricing uncertainty into exactly the instruments we've been discussing. Now let's talk about what professionals are actually watching right now, because it's more specific than most retail coverage suggests. First, the September Fed meeting. Interest rate swaps were pricing in roughly a 60% probability of a rate hike at that meeting, with a hike essentially fully priced in by December. That's a meaningful shift from where expectations sat just weeks earlier, and it reflects exactly the tension we've been describing. A Fed trying to balance cooling headline inflation against still elevated core measures in a bond market that's losing patience. Second, professionals are watching the shape of the yield curve itself, not just the headline 10-year number. A continued bear steepening, short rates flat or falling, long rates rising, would reinforce the credibility narrative. A parallel shift where everything rises together would suggest this is more conventional inflation repricing. Third, they're watching the dollar. Gold and the dollar have historically moved inversely, and continued dollar softness alongside rising yields would be additional confirmation that this isn't a simple higher rates equal stronger currency story, but something more unusual. Fourth, and this one doesn't get enough attention, professionals are watching central bank gold purchase data, which the World Gold Council publishes periodically. Sustained buying from central banks, even during a period when gold has already run up substantially, would suggest this is structural demand rather than speculative momentum. And fifth, they're watching Treasury auctions themselves. When the U.S. government sells 30-year bonds, the level of demand, measured by things like the bid to cover ratio and how much of the auction goes to indirect bidders, which includes foreign buyers, tells you in real time whether the credibility concerns we've discussed are showing up as actual reduced appetite for long-term U.S. debt, or whether this is mostly a psychological, headline-driven repricing that fades once the geopolitical noise settles. A weak auction, one where the Treasury has to pay up noticeably more than the market expected just to get the debt sold, tends to move markets far more than most economic data releases, precisely because it's a direct, real money referendum rather than a survey or an estimate. It's worth briefly addressing silver here too, since anyone watching gold closely tends to watch silver alongside it. Silver has historically moved in the same general direction as gold, but with noticeably more volatility in both directions, because silver sits at the intersection of two different demand stories. Part of its price is driven by the same safe haven and monetary logic as gold, but a larger share of silver demand relative to gold comes from industrial use, electronics, solar panel manufacturing, and various manufacturing processes. That means silver tends to respond not just to credibility questions and central bank behavior, but also to expectations about industrial growth and manufacturing activity. When gold and silver rise together, that typically reflects the monetary and safe haven story dominating. When silver lags gold noticeably, it can signal that industrial demand expectations are softening even as safe haven demand holds up. It's not a perfect indicator, but it's one more data point worth having on your radar if you're trying to gauge how much of gold's current move is about pure credibility versus broader economic anxiety. It's worth pausing to address something viewers outside the United States often ask about, because gold is a genuinely global asset, but it's quoted and settled overwhelmingly in US dollars. That means everything we've discussed about US Treasury credibility and Fed policy doesn't just matter to American investors. If you're in Canada, the UK, or Australia, gold priced in your own currency depends on two things moving simultaneously: the dollar price of gold itself and how your home currency is moving against the dollar. When the US dollar weakens, as it often does during periods when this kind of credibility question is being priced, gold tends to rise in dollar terms partly for that exact reason. It becomes cheaper for holders of other currencies to buy, which supports demand. But that also means a Canadian or British or Australian investor watching gold in dollar terms can sometimes see a different, less dramatic move once it's converted back into their own currency, particularly if their currency has also been strengthening against the dollar for unrelated domestic reasons. It's a detail that's easy to overlook when every headline quotes the dollar price, but it matters if you're actually trying to understand your own real-world exposure. Let's talk honestly about the different cases here, because a fair analysis has to hold more than one possibility at once. The bullish case for gold rests on several pillars: continued central bank diversification away from dollar assets, a Fed facing genuine internal disagreement about the inflation path, a term premium that suggests long-term lenders are demanding more compensation for holding government debt, and an unresolved geopolitical backdrop in the Middle East that could reignite at any point. Major banks have reflected this thinking in their targets. JP Morgan and Goldman Sachs have both put year-end forecasts in the range of $4,500 to $4,900, suggesting a recovery back toward, though not necessarily beyond, January's record high. The bearish case is just as worth taking seriously. If the cooling inflation trend seen in the June CPI report continues, and if the Iran conflict moves toward genuine, lasting de-escalation rather than a temporary pause, a lot of the safe haven premium currently built into gold's price could unwind. Some forecasts see gold retreating back toward the $3,200 to $3,600 range under that scenario, higher for longer real yields. If the Fed does end up hiking in September to defend its credibility, would also weigh directly on gold through that opportunity cost mechanism we discussed earlier, this time with real, not just nominal force behind it. And there's a subtler bearish risk worth naming after a run this dramatic. From under $2,000 a few years ago to above $5,500 at January's peak, a substantial amount of speculative length has already piled into gold. Crowded positioning of that kind doesn't need a fundamental reason to unwind. It can reverse simply because too many people are already leaning the same direction, and a modest catalyst is enough to trigger profit. Taking that feeds on itself. It's also worth being honest about what could prove this entire framework wrong, because intellectual honesty matters more than being right about a prediction. If the September CPI and jobs data both come in unambiguously soft, and the Fed cuts rather than hikes while simultaneously communicating a clear, unified message that restores confidence in its reaction function, the term premium could compress just as quickly as it expanded. Term premiums aren't permanent fixtures. They reflect a snapshot of market sentiment about long-run policy credibility, and that sentiment can shift in either direction based on the next few data points and the next few speeches. Nothing about this analysis should be read as a certainty. It's a description of where the evidence currently points, not a guarantee of where it ends up. And then there's a neutral, more probabilistic middle case, which is honestly where most experienced market watchers seem to sit right now. That view holds that gold is likely to remain volatile in range bound for a while longer, oscillating between roughly $4,000 and $4,500 until one of two things happens with real clarity. Either the Fed's September decision resolves the current disagreement in one direction, giving the market a clear signal about which policy path is dominant, or the geopolitical situation in the Middle East moves decisively toward resolution or escalation. Until one of those triggers clarifies, both gold and the bond market are likely to keep reflecting this unresolved tension, moving in ways that look contradictory to anyone applying yesterday's simple rule book, but make complete sense once you understand the credibility question sitting underneath the surface. There's one more piece of the puzzle worth adding, because the Fed doesn't just have an inflation target, it has a dual mandate, meaning it's also legally responsible for maximum employment, and that second half of the mandate is exactly what makes this decision so genuinely difficult rather than obvious. Recent labor market data has shown signs of losing momentum, even as core inflation ticked higher earlier in the year before the June cooling. That combination, a softening labor market alongside inflation that hasn't fully returned to target, is about the most uncomfortable position a central bank can be in. Cutting or holding rates risks looking too permissive on inflation. Hiking risks accelerating labor market weakness into something worse. There's no version of this decision that satisfies both halves of the mandate cleanly right now, which is precisely why three officials could look at the same data as their colleagues and reach a different conclusion about which risk deserves more weight. That's not dysfunction in the ordinary sense. It's what a genuinely difficult, data-dependent moment looks like from the inside. It's also worth being explicit about who benefits and who's exposed as this plays out, because it isn't evenly distributed. Long-term bondholders who bought 30-year treasuries at lower yields months or years ago are sitting on real if unrealized losses. Since bond prices move inversely to yields, every basis point higher on that 30-year yield erodes the market value of previously issued long-dated debt. Savers holding cash or short-term instruments are, in a narrow sense, somewhat insulated and in fact benefit from still elevated short-term rates on things like money market funds. Anyone with a variable rate loan or shopping for a new mortgage is directly exposed to this move through higher borrowing costs. Gold holders obviously have benefited from the recent bounce, though anyone who bought near January's $5,500 peak is still underwater even after this rally. And the government itself, as the single largest issuer of long-term debt in the world, faces higher interest expense on new issuance for as long as this dynamic persists, a cost that ultimately gets absorbed somewhere across the broader economy, whether through future budget decisions, tax policy, or simply higher costs of doing business. None of these effects exist in isolation. They're all downstream of the same credibility question this whole video has been built around. If I had to weigh which scenario currently has the most supporting evidence, I'd lean toward the neutral case, with a modest tilt toward the bullish structural argument over any 6 to 12-month horizon, not because I can predict what happens at the next Fed meeting, nobody can do that reliably, but because the structural forces behind this move, central bank buying, a term premium that reflects genuine institutional questions rather than short-term noise, and a level of policy disagreement inside the Fed that hasn't shown up this visibly in years, tend to resolve slowly, over quarters and years, not days. Geopolitical headlines can reverse overnight. Structural shifts in reserve allocation and institutional trust generally don't. Before we get to what this all means in the bigger picture, it's worth touching on how experienced investors tend to think through periods like this, structurally, without pretending anyone can time the exact top or bottom. This isn't a recommendation to buy or sell anything. That's not something I can tell you, and honestly, anyone who tells you with certainty what gold does next 6 months from now is selling confidence they don't actually have. But the general framework seasoned market participants use tends to center on a few honest questions. What role is gold actually playing in your broader financial picture? Is it a long-term store of value you're comfortable holding through multi-year cycles, or is it a shorter-term trade you're more sensitive to volatility on? How concentrated is your exposure, and would a 25% drawdown, the kind we already saw earlier this year, genuinely change your financial situation, or would it simply be uncomfortable to watch? And are you making decisions based on the structural themes we've walked through today, central bank behavior, term premiums, credibility questions that unfold over years, or are you reacting to a single day's headline, which is a very different and generally less reliable way to make decisions about a volatile asset? None of those questions have a universal answer. They depend entirely on your own circumstances, your own time horizon, and your own tolerance for uncertainty, which is exactly why this is a conversation to have with a qualified financial professional who actually knows your situation, not something to resolve from a YouTube video, however thorough. So what is it that the Fed isn't quite telling you in plain terms? It's not some hidden secret or conspiracy. Nothing in this story requires that kind of framing, and I'd be doing you a disservice if I dressed it up that way. It's something more mundane, and honestly more important. The Fed's public communication is built around near-term inflation and employment data because that's its actual legal mandate. But the bond market, particularly the long end of the curve, is pricing something the Fed's framework doesn't directly address: whether the institution can maintain enough internal consensus and enough public trust to keep long-run inflation expectations anchored, at a moment when it's running persistent internal disagreement, and at a moment when the government's long-term borrowing needs keep expanding regardless of which way any single rate decision goes. That's not a talking point you'll hear in a press conference, because it's not really the Fed's job to editorialize about its own credibility. It's the market's job to price it. And right now, that's exactly what long-term yields and gold are doing, each in their own way, describing the same underlying uncertainty from two different angles. So let's bring this full circle back to the contradiction we opened with. Gold above $4,100, 30-year yields at their highest since 2007. Two moves that, on the surface, shouldn't happen together. What we've walked through is that they're not actually contradicting each other at all. They're two different markets pricing the same underlying question from two different vantage points. The bond market is asking whether the institution managing monetary policy can maintain enough internal discipline and public trust to anchor inflation expectations over the next decade, and it's answering that question through a rising term premium on the long end of the curve, even while near-term inflation data cools. The gold market is asking a closely related question: whether the broader system of paper currencies and government debt deserves the same unquestioned trust it's traditionally been given. And it's answering that question through sustained central bank accumulation and renewed safe haven demand, even at prices that already reflect one of the greatest bull runs in gold's history. 3 dissenting votes at a single Fed meeting, a term premium quietly climbing, and a metal that pays no interest holding firm above $4,000. None of these are isolated data points. They're the same story told 3 different ways. Here's the idea I'd leave you with, because I think it's more useful than any specific price target. When two assets that are supposed to move in opposite directions start moving together, that's rarely a coincidence, and it's rarely something you should ignore just because it doesn't fit the simple version of the story. It's usually the market telling you the simple version of the story is missing something. Gold and long yields rising together right now isn't a broken relationship. It's the bond market and the gold market both independently pricing the same underlying question about long-term trust in the system, just through different instruments at different speeds for different reasons. Understanding that doesn't tell you exactly what happens next week, but it tells you what to actually watch And it tells you why the headlines that treat this as a simple story are probably the ones you should trust the least. So here's the question worth sitting with after this video ends. If the bond market is increasingly pricing long-term trust rather than short-term inflation, what does that mean for how you think about every other so-called safe asset in your portfolio, not just gold? That's not a question with an easy answer, and it's not one I'd pretend to answer for you. But it's the right question to be asking right now. If this kind of grounded evidence first breakdown was useful to you, I genuinely appreciate a like. And if you want more analysis like this as these dynamics keep evolving, consider subscribing. I've also put together a related breakdown on how central bank gold buying has reshaped the reserve landscape over the past few years. And I think it connects directly to everything we just covered here. So it's worth watching next if you want the fuller picture.